Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Rupert West of Puma Investments to talk about the two Puma VCTs. Hello Rupert, for those who aren't familiar, could you give us a bit of background to Puma Investments and your own experience?
So Puma Investments is an investment business. In the tax efficient space, we do the full service of products. So we have VCTs, we have EIS, we have some BR products. My division looks after all of our growth capital investments and equity investments. So again, in the tax efficient space, we run VCTs and EIS. Our two VCTs, Puma VCT 13 and Puma Alpha VCT, the two VCTs that are currently open. As you can see from the name 13, we've been doing this quite a long time. The first Puma VCT was launched in 2004. And this current strategy we've been running since 2018, and we have these two live open VCTs now. We run these as investment products. These are total return products designed to deliver good risk-adjusted returns to our investors. We run obviously within the constraints of the rules of VCTs, but those rules are very broad. So we try to focus specifically on slightly more mature companies with proven market fit and help those companies scale up. That's really the specific piece of expertise we can bring to the table for the management teams we back. So proven market fit, we are looking for companies that are beyond product fit, beyond customer fit, to businesses with a broad range of customers, demonstrating that their product has a clear fit in a broad marketplace. And we then help them with HR strategy, recruitment, personnel, culture, management, just sort of day-to-day good management of people, sales structures, sales strategies, and help them continue that scale-up journey, get them growing, get them bigger, and generate returns for our investors.
And your background?
I started off in investment banking, pretty mainstream structured finance investment banking, with an emerging markets focused bank and then Barclays Capital here in the UK. I moved into fund management investment about 15 years ago and worked with a series of institutional funds doing various work with that. And then I've been working with the Puma VCTs and EIS products for about the last 10 years and have run Puma Private Equity, which is the division that leads on the management of our growth capital for the past 4 years.
So what is it specifically that you're looking for when you look at these investee companies? Are there any particular sectors that you favour?
So we're fairly agnostic on sector. What we really look for is professionalised corporate management, people who are looking to build high quality, professionally run businesses. We actually slightly look to avoid real, pure, innovative entrepreneurs, people who are solo maverick thinkers. And the reason for that is, yes, that will mean we don't get 100 times return, incredibly disruptive and very probably exciting business, but we think that on average the failure rate will be much lower, and on average our returns will be much more consistent and much higher. And we see this again as running an investment product for people. We therefore have to look for businesses that we are most able to help, and that we are most able to work with closely, and that we are most likely to be able to either raise further finance into or exit. And for us, those are the professionally tightly run businesses. So in terms of what we look for from a management team, we do back founder-led, sort of single individual-led businesses, but we look very closely at the dynamics between that lead individual and the wider management team. And we look for quality decision-making processes. So we look for teams of people who are able to listen to each other, to work together. Doesn't mean they can't take decisions quickly, and doesn't mean they can't act aggressively when they need to, but people who are alert to the wider environment, are realistic about their need to scale, which means people, and their need to attract and retain those people and the best people they can get their hands on. And so that is the type of people that we specifically look for, and that is more important to us than the sector or sort of specific product type of the business.
Is there a minimum level of maturity that you'd look for in a company?
Yeah, the proven market fit concept is our sort of guide, and that will mean a slightly different thing for different sectors. But it would be very unusual that we'd be getting involved with a company that is less than 2 million of annual revenue, and for example, the average revenue of companies we've backed in say the last 2 years is about 3.5 million of revenue. So they are not startups; they're into the scale-up journey, which is the area we really focus on.
And do you have any recent examples of investments you've backed in the portfolios?
Yeah. The most recent investment we've closed is a business called Everpress, and this is a no waste sort of slow fashion, if you like, kind of crowdsourced t-shirt business where creators in the community with their own following, so artistic people, musical people, creators with a group of people who follow them and want to participate in their brand and sort of purchase goods from them, those people can post designs onto the Everpress platform, which can be printed up. The key differential of the model, and something that's very attractive to us from an ESG perspective and to customers of the business, is that the garments are then only produced when the order is finished. So they're built to order with no wastage. Wastage is a huge problem in the fashion industry, for all the reasons we sort of hear about and are reasonably obvious. So that's an aspect of the business that we liked. But really, to our sort of core themes, what we liked about the business is the way it's run, the focus on quality of management, quality of decision making, and the calibre of individuals that the founder has really gone out of his way to attract into his business. So whilst the founder, Alex, is a very capable, experienced individual who came from the printing sector and we really rate, he has gone out of his way to pull into the sort of wider ecosystem of the business top talent with great experience. For example, the chair of the business is the former CEO of the White Company, knows a thing or two about retail. And that for us is a genuine statement about the type of people we want to back, in that these are people who have gone out and sought people with more experience than them, and that our founders who we back are humble enough, sensible enough to go and find that experience and then listen to it, while still driving the business themselves and bringing their own personality and skills and innovation and hunger.
Do you have any other recent examples?
Yeah, another business we've backed this year is called Cameramatics. It's a fleet management business, so works within telematics, which is tracking vehicles and their movements and interactions that the drivers in the vehicle makes. So this is a camera-enabled software solution for fleet managers who are looking after a broad range of vehicles, different vehicle types, and needs to see in a consolidated dashboard approach, needs to see information about all those vehicles. Now, what we like about this business and some of our sort of real themes that we look for that it brings to life are that this was a big sector there waiting, a big customer base already in place. So the Cameramatics business had developed a new way of solving a problem that was already there. They weren't trying to drive, they didn't need to drive any behavioural change in their customers. That's very important to us. It's part of the proven market fit concept, in that we like to back disruptive businesses selling into a big established sector rather than businesses with a disruptive product that requires behavioural change from the adopters. And on top of that, the business was again run by very seasoned people, former business owners, always had worked within this sector, really knew what they were doing, and have built up over the period of our hold now, some months, built up further very high caliber people that they've gone and purposefully sought out the best in the industry that they're willing to have in their business and open to taking input and challenge from to help the business grow.
So two good recent examples there, Rupert. What about some of the more established holdings within the portfolios?
Yeah, we've been very pleased with performance over this year. Obviously a difficult year, but our funds have done well. And several of our businesses, as they have longer in our period of hold, are really following our intended arc, which is to take a business when it's when it's at that sort of scale up point of 3 to 5 million of revenue, and then we work very closely with them and push them probably through one or two natural funding cycles where we come in and put in additional money, which we frequently do, and get them to the point where they can either exit or attract a much more material funding round to continue their growth. And several of our businesses are following that trajectory, that arc, very closely. Some really good examples that have had strong performance in the last 6 to 12 months is Le Col, our cycling apparel business, which they make top quality performance racing bike clothing, it's an e-com business, and they sell predominantly online, although they're soon going to be appearing in John Lewis and some other key retailers. That business was set up by a former pro cyclist, and really the passion for the quality of the product is what is the driving force of that business and is pervasive through the brand. And performance has clearly been very good through the pandemic, as cycling was one of the few things you were able to do. But that has not been just for luck. That has been through good management and some very careful decisions that the management team have made. Another good example is Influencer, which is a data-driven, tech-enabled digital marketing platform. That is a business that clearly had potentially some enormous challenges into the pandemic, with several sectors withdrawing from marketing because they were not able to provide their product, so hospitality, travel, tourism, etc., which initially was a real threat to this business. But by working very closely, us with them, working tightly on management and on sales structures and on target customers, the business is now really flourishing and has bright hopes as it expands into the Middle East and the US, actually, in sort of two big strategic pushes.
So how did the pandemic affect your portfolio as a whole?
Now, in the fullness of time, our performance has been very positive. So our two open VCTs posted earnings per share of roughly 25% over the 12 months to their last released accounts. So that is a good performance. But the pandemic was a very stressful time, and I think we should never overlook that regardless of how well a business has done over a period of time like that, the management team have taken have soaked up a lot of challenge, a lot of stress. So the beginning of the pandemic was certainly a time where we were working incredibly closely with all of the portfolio, and it was all about cash management and cash forecasting and reaction to these very big social changes that really nobody knew how to read. We then moved into a phase where that stabilised slightly, and we focused on keeping the portfolio abreast of all of the government support packages, so really they could carry on with the day-to-day, and putting on lots of information sessions where we lent on our advisors and sort of top expertise in law and finance to provide information and webinars and written information to our portfolio. So that was sort of in part how we reacted. But it has been a challenging time, and I think we should not underestimate the risks that it has left in the economy, where large pools of businesses, although they are there and functioning, they are in a stretched position from a working capital perspective. And we as managers must help our portfolio companies read that and react to that and be cautious actually at this time, which is seemingly strong acceleration out of the problems. We must help them remain alert and prudent.
So Rupert, that's probably a good point at which to ask about the risks within the VCT. So of the companies you're backing, how many do you expect to fail? How would you quantify their risks for investors?
So our approach is extremely focused on active management, hands-on involvement from us. We work very, very closely with our portfolio companies, and our positioning of backing slightly more mature, scale-up rather than start-up businesses should mean that we have a lower failure rate in our portfolios than the broader market. That really fits in with the theme of what we're trying to deliver, which is overall higher risk-adjusted returns for these to be investment products for our investors. So we will have fewer of the 100 times return, got a bit lucky, hit an innovative startup, could have all gone wrong, shot the lights out, but we will have fewer of the failures. And on average, we feel that will deliver higher, more stable returns over time.
So what about exits within the portfolio? Have you had any exits recently?
Yeah, it's an interesting market to be exiting because values are reasonably high, although risks are high, and I think there's more structural protection underneath the valuations than is sometimes sort of talked about. But our most recent exit was a good example of sort of what we do and how we try to reach these returns for investors. We had invested into a business that was funeral planning within the cremation space, a business called Pure Cremation, and they built into being the UK market leader of direct cremations, which is non-attended services. So rather than gathering with your relatives at a slightly dismal 1960s council-owned crematorium, you have the deceased cremated by this company elsewhere from you. The ashes are brought back to you, and you use the savings, you use the balance of the money to have a celebration of life at a venue that you choose and that was special to the individual. In all the sort of ticking all the boxes that we like to see in a business, this was a very mature management team that had run businesses in the past. It was a disruptive model, but servicing into a big established sector. They had sought out some genuinely expert, experienced people to build out and grow their infrastructure and logistics team. We got into that business when revenues were at about 3.5 million, and we made 4 times our money for Puma VC13, which is for us an example that we can do what we do and we can generate very decent returns for our investors without taking the risk of backing startup businesses.
And so what about dividends within the VCTs? Both VCTs are relatively new. When can investors start to see dividends?
So Puma VCT13 has declared its first dividend, which will be paid shortly, and that is from the realised gains of the Pure Cremation exit. And the board of the VCTs has also spoken about its intentions to pay out the balance of that realised gain in a follow-on dividend that'll be before the end of the tax year. Alpha VCT follows a similar strategy. It runs the same mandate, so people could, I think, reasonably expect that to follow a similar pattern of paying out a dividend upon its first realisation, and it has now several positions that are performing well, that are reaching a level where a liquidity event is perfectly feasible.
Do you have a target dividend yield that you hope to reach in the future?
So there are stated target dividend yields in the prospectus, but I would add to that these are not bank accounts, these are not savings products, these are investment products designed to deliver total return. And personally, I think the VCT rules constrain you to invest into certain companies, and they also constrain the amount you can invest per company. So you are not able to start with very small tickets across a very big pool and assume that you can invest up to very big sums in your winners, because you can't. There's a cap on what you can put in. So as your fund gets very big, your ability to have single positions that are a dominant part of the equity you've committed is reduced, because you hit a certain threshold of how much you can put in. So you are forced to be committing your capital to relatively small, hopefully high growth businesses. You should be a bit nervous if you're taking that equity growth risk, and transmuting that to investors into an income-like yield, because we don't feel that income is commensurate with the risk being taken. So we are trying to deliver material units of capital value appreciation. So our dividend flow, although we have given in the prospectus guidance of the average amount, it will not be even. It will be from material realisations and distributions.
Okay. So to sum up then, Rupert, I have some money I want to invest into a VCT this year. Why should I invest in the Puma VCTs?
I think our VCTs are suitable for people who are looking at a very actively managed investment product that's seeking to back scale up rather than start-up businesses. They are unlikely to be the most disruptive, most exciting business that you're expecting to turn into a £1 trillion business, but they will be well run, they will be tightly looked after, and they will hopefully deliver you a consistent, attractive risk-adjusted return.
Rupert West of Puma Investments, thank you very much.
Thank you.